JP Morgan's global head of macro quantitative and derivative strategy, Marko Kalanovic, has warned that the stock market is in the calm before the storm and that investors should expect a reversal in risk sentiment with the market retesting last year's low over the coming months. Kalanovic argues that recent inflows into stocks make little sense and are largely driven by systematic investors, a short squeeze, and a decline in the CBOE Volatility Index, VIX. He characterizes the present market backdrop as being the calm before the storm and highlights that a drop in the VIX below 20, a level associated with less stressful periods, suggests investors believe that the banking crisis is contained in the near term. However, Kalanovic believes that the current market situation is unsustainable and warns that the original source of stress, rates higher for longer, can re-enter the picture. Kalanovic cut his equity allocation in mid-December, January, and March due to a soft economic outlook this year. Despite rising interest rates, stocks have remained resilient this year and tech's outperformance has become even more magnified recently as traders ramp up bets that banking system stresses will prompt the Federal Reserve to hit the brakes on its tightening campaign. Citigroup strategists including Chris Montague said net positioning turned clearly bullish for the S&P 500 over the past week. There's still $15 billion of shorts to clear, which could support markets in the near term, they wrote in a separate note on Monday. U.S. stock futures were steady on Tuesday, with contracts on the S&P 500 dipping less than 0.1%, while those on the Nasdaq 100 edged 0.2% lower by 3:51 a.m. in New York. Kalanovic was one of Wall Street's biggest optimists through most of the market sell-off last year, but he has since reversed his view, cutting his equity allocation due to a soft economic outlook. Kalanovic predicts that investors will see a reversal in risk sentiment over the coming months and the market will retest last year's low. He argues that the recent inflows into stocks, which he claims make little sense, are largely driven by systematic investors, a short squeeze, and a decline in the VIX. The current market backdrop is unsustainable, he says, and warns that higher interest rates could reignite market stress. You have now received your deposit. If you like these stories, please like and subscribe, and don't forget to click the bell icon to be the first to receive all of my new content as it becomes available.